Good afternoon, everyone, and welcome to the AASB webinar in relation to Exposure Draft ED 291, which addresses a proposed new definition of not-for-profit entity and to provide guidance thereon. My name is Clark Anstis. I'm a technical principal on the staff of the AASB, and I have with me Peter Lucas, a practice fellow on secondment from the Taxation Office, also on the AASB staff. Thank you very much for joining our webinar. We want to run through the requirements in the exposure draft so that you have an understanding of what the proposals are, and we would certainly ask that you provide your comments to the AASB prior to the comment due date. Your comments will be very helpful in the board deciding whether to change the current definition. The exposure draft was issued early in June and has a comment date of early September. So that's about a 90-day period for comments, so we hope that that would be sufficient for you. This slide gives you the big picture. If you hear nothing else today, we hope that you'll take these messages. The current definition of not-for-profit entity in the standards is a very negative one. Basically says you're a not-for-profit entity if your primary objective is not to generate a profit. So very, very negative. We've had that definition for a very long time, but it's not particularly helpful. The proposal in the ED, therefore, is to insert a new substantive definition into AASB 1057, which is the standard that addresses the application of Australian accounting standards. But not just the new definition, also to provide implementation guidance that would be included in an appendix to AASB 1057. And then also, along with that, some illustrative examples. The illustrative examples are intended to provide an illustration of how the principles in the proposed definition could be applied in cases that we think would be relatively common. We think it's important to understand why these proposals are being made by the board at this time. Firstly, there are different requirements in the Australian accounting standards for for-profit versus not-for-profit entities. Most of you will be familiar with the Oz paragraphs that appear in various standards, and these are paragraphs that modify the main requirements in respect of not-for-profit entities. Remember that the requirements in standards are based on IFRS standards in the first instance, so that compliance with Australian accounting standards by for-profit private sector entities will automatically mean compliance with IFRS standards. However, IFRS compliance is not so important for not-for-profit entities, and therefore the AASB does make amendments to those for-profit requirements for not-for-profit entities. Just a couple of examples. The board at the end of 2016 issued a new standard, AASB 1058, income of not-for-profit entities. And as the title suggests, that applies only to not-for-profit entities and assists such entities in how to account for transactions that are outside the scope of AASB 15, the revenue from contracts with customers standard. So if you're a not-for-profit entity, you would account for government grants and other grants in accordance with AASB 1058. In contrast with the accounting for for-profit entities, for whom AASB 120, accounting for government grants and disclosure of government assistance, is the relevant standard. The accounting for grants, therefore, is quite different. And just to note for you that The AASB staff produced and published a paper in 2017, published on our website, which sets out the modifications made in Australian standards for not-for-profit entities. So that's quite a useful publication. In addition to the different accounting requirements, the board at present is undertaking a very significant project which we have labelled the Australian Financial Reporting Framework Project. Now, this project is to reconsider, in conjunction with other regulators, the financial reporting requirements for Australian entities. And so many of you will know that we've issued a new conceptual framework which applies to certain for-profit entities at present, but not to not-for-profit entities at the moment. So the board at the moment has concentrated first on addressing the accounting framework for reporting framework for for-profit entities, and has decided that it will address the reporting framework for not-for-profit entities in due course. In doing so, it will work very closely with the relevant regulators, such as the Australian Charities and Not-for-Profits Commission, and also with other state and territory regulators who deal, for example, with incorporated associations and cooperatives. So the ultimate reporting framework for not-for-profit entities could be significantly different from that for for-profit entities. We know that today, through AASB 1053, we have 2 tiers of reporting under Australian accounting standards. Tier 1, which is full general purpose financial statements, and Tier 2, which at present is the reduced disclosure requirements framework. Tier 2 proposals at present are on foot, which would change the requirements from RDR requirements to specified disclosures, and those proposals are to apply both to for-profit and not-for-profit entities. But the future development of the reporting framework for not-for-profit entities could indeed conclude that 3 tiers are appropriate for not-for-profit entities rather than 2. So there could in the future be a 3rd tier which would allow some form of simplified reporting in accordance with standards for not-for-profit entities. No decisions on that have been made. Various proposals and possibilities have been published, but none yet are exposed drafts. We also published in October 2017 Invitation to Comment 37, which proposed standard setting frameworks separately for the for-profit sector and also not-for-profit entities. Those 2 frameworks were issued in 2018 and are available on the website. The feedback received in respect of that invitation to comment indicated that there was support for retaining the term not-for-profit entity, for example, rather than using the New Zealand term, which is public benefit entity. But the feedback also suggested that our current definition, the fairly negative one, really wasn't enough and that further guidance should be provided. And there was support in that feedback for monitoring the New Zealand work in updating their definition of public benefit entity, which work was concluded in May this year when the New Zealand standard setters issued a new appendix to a standard that revised the definition and the guidance. What then are the AASB proposals in ED 291? Well, firstly, yes, to retain the term not-for-profit entity, particularly to remove the existing definition which appears in 3 standards. So the lucky 3, 102, 116 and 136. The board considered where to include a revised definition in the standards. There were a number of choices. It could be in AASB 1053, which is the standard addressing the application of T's of accounting standards. Potentially a separate standard altogether, but the board's conclusion was that it would be appropriate to include in 1057, which is the application of Australian accounting standards standard. The board looked at the New Zealand proposals and decided that with some minor adaptation, they would be the definition in New Zealand and the guidance would be appropriate to adopt in Australia. The reference there on the slide is to the XRB standard A1. The XRB is the External Reporting Board in New Zealand, which oversees the activities of the New Zealand Accounting Standards Board. So the XRB is in much the same position as the Financial Reporting Council is relevant to the AASB. The XRB can issue standards and does so in respect of general framework requirements. The SMC reference here is to specific matters for comment in ED 291. So these slides will just give you a link to the relevant specific matters for comment. In addition to the revised definition, mandatory implementation guidance. So a number of SMCs relate to that. The provision of illustrative examples. And just to note here, SMC 5 does ask a question whether you agree with the approach in the proposals, which is to say no special transitional relief is proposed on initial application of a standard resulting from ED 291. So the only impact of that initial application could be if the classification of your entity was to change from for-profit to not-for-profit or vice versa. In that case, the proposals do not say there are any special transition requirements. And we'll address that further with a later slide. Now, there are only 7 specific matters for comment in the exposure draft. And you'll notice that 3 and 4 don't rate a mention on this slide. We will get to those. Well, that's pretty much the background for this exposure draft. Let's get into some of the detail. So this slide and the next will actually show you what the current definition is and the proposed new definition. So the term not-for-profit entity, which is currently defined in those 3 standards, and it's not, I don't think there's any particular reason why they happen to be in those 3, there they are. The current definition, an entity whose principal objective is not the generation of profit. And the further sentence simply says a not-for-profit entity can be a single entity or a group of entities. So this definition really only tells you 2 things. One, we're concerned about the principal objective of the entity or the group of entities. And secondly, that principal objective can't be the generation of a profit. It doesn't tell you an awful lot. And it doesn't prevent not-for-profit entities generating profit, which of course typically they would need to do in order to remain solvent and to continue in the activities that they wish to provide. So this is why I think it's convenient just to say the current definition is a negative definition. Principal objective, not to generate profit. We've had the definition for a long time. There have been a few attempts previously, probably at least now a decade ago, raising the question of whether we should change the definition. But none of those attempts really concluded that change was appropriate. The proposed new definition then, drawn from the New Zealand standard, a not-for-profit entity would be an entity whose primary objective is to provide goods or services for community or social benefit. So that sounds very similar to the, in part to the current definition, but there's a further part where any equity has been provided with a view to supporting that primary objective rather than for a financial return to equity holders. Both parts need to be assessed in combination to determine whether an entity should be classified as a not-for-profit entity or a for-profit entity. The two parts of the definition really should work together in reaching a classification. But of course, there are going to be cases where it's possible to have conflicting assessments of primary objective and equity, and so a judgment is really going to be required. But the mere fact of, excuse me, the mere fact of having equity and identifiable equity holders is not sufficient to classify an entity as for-profit. So it's a matter of assessing all the circumstances in order to apply the definition. The proposed new definition clearly has a greater focus on the nature and purpose of a not-for-profit entity. It seeks to identify what it's about rather than what it's not. The current definition, of course, referring just to the principal objective, not the generation of profit. Of course, in many cases, it will be obvious whether an entity is a not-for-profit entity. For example, most charities, without too much thought, you would think would be able to classify themselves as not-for-profit entities. But in some cases, it won't be immediately obvious. And it's important that the substance of the entity's purpose is identified in trying to assess the primary objective of the entity. Is it to provide goods or services for community or social benefit? Is it to provide a financial return for the members of the entity? And that could apply whether we're talking about a company or a mutual entity, for example. What's the basic or primary objective of the entity? Some of the implications of this definition. Not-for-profit entities may be public or private sector entities. And conversely, for-profit entities may be public or private sector entities. The definition is written in a way that if you fall outside that definition of not-for-profit entities, then you would be a for-profit entity. So for-profit entities encompass all entities other than not-for-profits. The legal form of an entity is unlikely to be conclusive. So just because you have a company with identifiable shareholders doesn't necessarily mean that the entity would be for-profit. In fact, we know that there are certainly companies in existence that have not-for-profit objectives. Not-for-profit entities may benefit the public as a whole, whether providing services generally or providing perhaps advocacy services or policy proposals to governments or whatever it might be. but it's not a requirement for not-for-profit entities to provide services to the public as a whole. And it could well be that in many cases, not-for-profit entities provide services to specified groups of people, whether people living in particular regions or with specific types of disabilities or economic needs, whatever it might be. In assessing whether an entity is a not-for-profit entity, the assessment is made for that entity, regardless of the group in which it may sit. But also the classification of the entity doesn't determine the classification of the group. So here we see a reference to specific matter for comment number 3, which is asking whether you agree that the proposal that the group classification is based on the group characteristics. And just to provide some further assistance there, the proposal is that the classification of the controlling entity would most likely determine the group classification. Now that says most likely, so that means there's room for judgment. And I think we would certainly find it useful to receive comments on this question. What would be the effect on classification of the group if the controlling entity had only very minor activities compared to other entities in the group? So it's I think, going to be an interesting question with the cases in which the controlling entity classification might not determine the group classification. So if you have views on that, then that would be very useful. So that's then is a quick overview of the new definition. And now we'll move to a number of indicators that are proposed in the implementation guidance for, in fact, applying this proposed new definition. And so now I'll pass over to my colleague, Peter. Thanks, Peter.
Thanks, Clark. So, yeah, I'll be taking you through the indicators. What the implementation provides is key indicators which help for determining the entity classification. And just in terms of structure, we'll first discuss these indicators and what they are. And later on, we'll show with illustrative examples how these key indicators are used to help determine entity classification. The indicators, they aim to focus on the substance of an entity's purpose. And so we've just listed them there, and we'll go through each one of them in the subsequent slides. So the indicators, they're the stated objectives. Then we have the nature of the benefits, including the quantum of the expected financial benefits. We have the primary beneficiaries of the benefits. We have the nature of any equity interests, the purpose and use of assets, and the nature of funding. So we'll just go through them now in more detail. Just one thing to note is that it's unlikely that any one indicator will be conclusive, and it may be necessary to consider several indicators together. And professional judgment would be important, would be required when considering and balancing the assessment of each indicator. And we have a reference there to specific matter for comment number 2. Now, the first indicator we'll talk about, it's the stated objectives. So they can be, you could have stated objectives potentially found in governing legislation. It could be constitution or a trust deed, or it could be any other founding document as well. Now, one of the issues that can arise is there may be multiple objectives. And what do you do? How do you determine the primary objective? It may not tell you in the document itself, which is the primary objective. In that situation, you'll determine the primary objective based on the substance of the entity's purpose. And in that regard, it may be helpful to consider how an entity assesses its performance. So what we've got there is that in that regard, if we've got performance targets based on the rate of return to equity holders, well, that may indicate that it's a for-profit entity. By contrast, if we have performance targets based on the level of benefits delivered to achieve a community or social outcome, well, that may indicate that we have a non-for-profit entity. Just another thing to bear in mind with stated objectives for public sector entities, their focus could be on internal administration rather than having a stated objective of directly providing goods and services for community or social benefit. Now, in that case, such an entity may still be a non-for-profit entity if the entity's primary purpose is to facilitate the provision of goods and services for community or social benefit. So indirectly in that way, facilitating in that way would be okay. The other thing that to mention is that the founding documents may require an entity to be financially viable or to generate an adequate rate of return. Now, requirement to be financially viable is not conclusive. There is a community expectation that non-for-profits will be financially viable and that limited resources that they're used effectively and efficiently. So just now move on to the next indicators. The next indicator is the nature of the benefits, including the quantum of expected financial benefits. Now, in relation to non-for-profit entities, they provide goods or services for community and social benefit rather than to generate financial surplus to provide a return to equity holders. Now, we have a situation where a non-for-profit generates a financial surplus. Well, in that case, it may be required or expected that it's used to support the entity's primary objective of providing goods or services for community and social benefit. By contrast, for most for-profit entities, they aim to generate a commercial or market return and maximize the return to equity holders commensurate with the level of risk. And therefore, the quantum of the expected financial benefits may indicate entity classification. One thing to bear in mind is that financial benefits for equity holders may take various forms. Often it can be payment of dividends, but there can be other forms as well, such as you may have a rebate to members of a cooperative, for example. Now, non-for-profit entities, just another point, they may establish controlled entities or discrete business units that operate to generate a financial surplus that can be used to support the primary activities of the controlling entity. We actually have an illustrative example later on in the presentation that sort of brings this out. Now, such entities or business units, they may be for profit. That does not affect the classification of the controlling entity. So just moving on to the next indicator, which is the primary beneficiaries of the benefits. So firstly, just in relation to for-profit entities, well, the primary beneficiaries of a for-profit entity, it's typically as equity holders or other economic resource providers, such as debt holders. And what happens is that these parties provide economic resources to the entity in exchange for an entitlement to financial returns. In contrast that, the primary beneficiaries of non-for-profit entities, well, they're basically members of the community or a particular section of the community rather than resource providers. So just moving on, the next indicator now is the nature of the equity interest. So in relation to for-profit entities, the ownership interest is usually clearly defined. And that's important because it determines their rights to returns such as dividends and rights to residual net assets. So it's important the ownership interest is clearly defined. Now it's likely that a non-for-profit entity, it's likely to have we have a non-for-profit entity if it does not have clear equity holders, or the nature of the equity instrument is unclear. Now, just some examples of not having clear equity holders which the ED provides are as follows. No right to participate in any financial return or in the net assets of the entity if it is wound up or ceases to operate. There may also be a requirement that if the entity ceases to operate, any residual net assets are applied to another entity with a similar purpose or revert to a not-for-profit entity. The purpose and the use of assets is the next indicator. So classification may be indicated by the reasons an entity acquires and or holds assets. So in relation to for-profit entities, while they hold assets mainly for sale or for generating a financial benefit for equity holders. By contrast, the primary reason non-for-profit entities hold property, plant and equipment and other assets, it's usually for their potential to provide future services for community or social benefit. So some examples in relation to not-for-profit entities, they may hold assets that, well, they may contribute to the historical and cultural character of a nation or region, or maybe responsible for national parkland. So in those situations, you know, those historical items and land, they're not held for sale. Now the last indicator is the nature of the funding. Now, many non-for-profit entities, they depend on grants and donations, and the sources of funding, they're usually from third parties. So that's other than the beneficiaries of their services. And restrictions may be imposed by the provider on how the funds may be spent. Non-for-profit entities may also receive funding from donated services. So you may have volunteers rather than paid employees. Contrast that with for-profit entities. They're funded primarily by equity holders, debt holders, and other providers of economic resources. Just finally, you may have a situation where indicators, they may conflict with each other, and the primary objective or purpose of the entity may not be obvious. And again, in that situation, the professional judgment is required in such a case to determine whether in substance the entity meets the definition of a non-for-profit entity. I'll just hand it over now to Clark, who will take you through the next series of slides.
Very good, thanks, Peter. We're now on slide 20, changing classification, and this is subject to a question in the exposure draft, specific matter for comment number 4, asking whether you agree with the proposed guidance in respect of an entity changing classification from for-profit to not-for-profit or vice versa, and whether the proposed guidance would be sufficient in practice. Now, this guidance, which is in paragraphs 38 and 39 of the exposure draft, would apply both to subsequent application of the guidance, so if the guidance is already in place, and also to initial application of the guidance. So I said previously that there were no special transitional provisions proposed in respect of initial application, but the proposals here in respect of changing classification would also apply in that initial application case. Now, the statement is made that a classification change would not be expected to be common, but clearly it can happen, and so hence we have these proposals. A change in classification between for-profit and not-for-profit could well be based on a change in the constitution or founding document of an entity. It may change its focus to a not-for-profit focus or otherwise. So there could be many reasons for the change. That's not for the standard to identify, but in your application, you need to consider whether a change of classification is appropriate. If it is, then there are various requirements specified for accounting for that change. Now, first and foremost, of course, would be the reclassified entity would have to apply the newly relevant accounting requirements set out in accounting standards. So if a for-profit entity became a not-for-profit entity, then for the first time it would have to start thinking about the requirements in AASB 1058, income of not-for-profit entities, and would have to change its accounting for any government grants that it had received previously, which would have been accounted for as a for-profit entity under AASB 120. Now, as a change in accounting policy, the relevant standard is AASB 108, the accounting policy standard, and that has a number of requirements that would be applicable. A change in classification under this standard, the amendments to AASB 1057, if the board finalises those, that means that the AASB 108 references would apply to a change of accounting policies required by a standard, rather than voluntary changes of accounting policies. And so AASB 108 has requirements for retrospective application if the newly applicable standards do not have transitional requirements otherwise in them. So AASB 108 is directly relevant if the entity is already applying Australian accounting standards. The alternative could be if the entity in its most recent financial statements did not comply with Australian accounting standards, whether Tier 1 or Tier 2, in which case AASB 1053, the application of tiers of Australian accounting standard, would be relevant. AASB 1053 covers two distinct cases. One is where this is the first time adoption of Australian accounting standards, and the approach in that case is to apply AASB 1. An alternative case under AASB 1053 is to reapply the accounting standards if in the past the accounting standards have been applied. And in this case, again, AASB 1 may be applied, or there is an option under AASB 1 in this circumstance for retrospective application per AASB 108. So there may not be a great difference in the effect of the transition depending on your previous compliance, whether in the previous financial statements or before that. But if this is your first time application, then AASB 1 could provide some relief to the entity. So the requirements there are quite detailed and do bear careful reading. Let's move on to some illustrative examples. Now, these illustrative examples are not intended to be prescriptive. They are not mandatory, so they don't actually contain mandatory requirements. The examples do not reach conclusions. They run through the various indicators that Peter has referred to in the cases presented, and say, well, if the objectives were this, then that implies for-profit. If the objectives were something else, then that applies not-for-profit, and so on. Goes through the possibilities for those indicators without actually reaching a conclusion. So, of course, in a real case, you must consider all of the facts and circumstances in making the assessment. Now, we have received a question from a participant asking whether all charities should be classified as not-for-profit because charities only have charitable purposes. Well, as a standard setter, I can't give you such a definite answer. So we might say that it would be most likely that charities are not-for-profit entities, but we cannot give a categoric response. And so these examples will illustrate how you might apply the various indicators to identify whether the entity, in your judgment, is for-profit or not-for-profit. Similarly with credit unions and mutual entities, again, we can't give a definite answer, but if, for instance, there are no explicit financial returns to the members of a credit union, then and any profit and capital is intended to support the provision of discounted services to the members and perhaps other social purposes as well, then you might well conclude a credit union could be in those circumstances a not-for-profit entity. But again, I stress it must be based on an assessment of all the circumstances. Let's move on to the first example. Now, this is an Australian example. So the New Zealand example was quite specific to New Zealand circumstances, so we have replaced the example. Our example is an entity that provides water and wastewater services for a number of regional communities. It's a wholly owned state company. The stated objectives, well, they cover a range. Efficient operation of the activities, maximising the contribution to the economy. Well, that all sounds like a for-profit entity, doesn't it? But also the entity has some objectives related to its social responsibility, support of sustainable development in the region, regional development. So you can see it's not clear-cut based on those stated objectives whether the entity is for-profit or not-for-profit. What about the nature of the benefits provided? Does the entity operate under a government business model that specifies financial and efficiency performance targets? Or alternatively, does the financial expectations for the entity permit or require it to charge customers at discounted rates, to reinvest its surplus in the public interest in respect of the regions? Are there particular non-financial performance targets to meet? So those different factors can suggest for-profit classification or not-for-profit classification. So again, if there are a mix of benefits or expectations, then those will have to be weighed in reaching a conclusion. Who are the primary beneficiaries? Well, if the principal objective is a financial return to the government, then the primary beneficiary, of course, would be the government. But with a sense of social responsibility and so on, perhaps that's regional communities. The purpose and use of assets, these are very similar questions. Is the entity intending to earn a commercial return on the assets of the entity, or are they more interested in providing effective and up-to-date infrastructure for the communities? And the nature of funding, again, reflecting some of those other factors and indicators. Are they charging commercial fees? Are they able to charge discounted or subsidised fees as a result of government grants or other grants? And what other sources of finance might there be for the entity, and if so, what returns to those finance providers are anticipated. So all of those factors need to be considered in reaching a conclusion whether the entity is a for-profit entity or a not-for-profit entity. The second example is an interesting example of a bicycle shop owned by a charitable trust. The charitable trust exists to provide health services to the homeless and to try to fund an expanded range of services. The trust establishes the bicycle shop in the form of a company. The company sells second-hand bicycles, runs a bicycle hire service. All surpluses from Company 1 are returned to the trust to support its objectives. So on the face of it, we don't know really whether this is a for-profit or a not-for-profit entity in terms of the company. So here, in this example, we're talking about the classification of the company. So you'd have to assess what are its stated objectives. Are they financial returns for its equity holder, that is the trust? Or are the stated objectives of the company related to providing community or social benefit, in which case you would think that would suggest a not-for-profit entity? Well, in addition, of course, to just the stated objectives, you need to consider the other indicators. The nature of the benefits. Are the bicycles sold or hired at market rates or below market rates? Does the shop provide employment to the homeless or disadvantaged? Or are they fully paid staff? So these different views of the benefits that the company might provide will reflect upon its classification as for-profit or not-for-profit. As a company, the nature of the equity interest is clear. The company would have shares owned by the trust. But you need also to consider whether the residual assets of the company, perhaps in a winding up case, can be applied to the benefit of the trust. Do the trustees have the choice what to do with the residual assets? Or does the company constitution require any residual assets to be forwarded to similar entities or other entities providing services to the homeless or disadvantaged? So who are the primary beneficiaries of the company? Is it the trust itself, or is it homeless, disadvantaged, or other people that they're trying to assist? And relevant to this question is also the nature of the funding. If most of the staff are volunteers and a significant number of bicycles are donated to the company, then that would suggest not-for-profit entity as one factor supporting that conclusion. Does the sale and hire of bicycles occur at market rates? Does the trust expect a return on its investment? Those factors could indeed suggest a for-profit entity. So as you can see, the example doesn't reach a conclusion. It just raises factors that would need to be considered and classifies those based on the indicators proposed in the exposure draft. I'll now pass back to Peter for some further examples.
Thanks, Clark. So the next example deals with the private education organisation. Now, in this case, we have Entity B, it's a trust. It provides low-cost, high-quality education to children who migrated to Australia from poverty-stricken countries. At the same time, though, it also accepts a limited number of fee-paying students. So in terms of stated objectives, I mean, if you look at what the trust deed says, if it says something like the objective is to provide high-quality education to immigrant children from poverty-stricken countries, that may indicate that this entity is a non-for-profit. By contrast, if it says something like, well, the objective is to maximise the financial surplus from fee-paying students, whilst also providing education to immigrant children, that may indicate that the entity is a for-profit entity. So I've just got some examples of the indicators. I won't go through every one of them in interest of time. The slides will be provided to you just in response to a question I was asked as well. Just some indicators there, the nature of the benefits, other financial targets expressed in meeting education objectives. Okay, so that may indicate the entity is not for profit, or alternatively, is it expressed in terms of a return on equity, which may indicate for-profit entity. The nature of the equity interest, another indicator. Is there something in there that says, well, if it ceases to operate, does the trust deed require the residual assets to be distributed to another entity with a similar purpose? If that's in there, it may indicate it's a not-for-profit entity. In terms of funding, is the funding mainly derived from fee-paying students and other resource providers in exchange for financial returns? If that's the case, it may indicate that we have a for-profit entity. Or alternatively, is funding derived from third parties who do not receive an entitlement to financial returns? And they may indicate that we have a non-for-profit entity. Just a couple of other examples. We also have a sports club. So we may have a suburban football club that organises competitions and provides coaching and training for a wide range of age groups. So I've just got listed there some of the indicators. Again, we're not going to go through each one of them. In terms of the nature of the benefits, does the club sell a significant amount of its services at market rates to generate financial returns for the club or its members? If yes, that might indicate we have a for-profit entity. Alternatively, does the club use its surpluses to ensure the club remains financially viable and to develop the services it offers? And that might indicate that a not-for-profit entity. In terms of the nature of the equity interest, again, if it ceases to operate, does the constituent document require the residual assets to be distributed to another entity with similar purpose? If yes, that may indicate that we have a not-for-profit entity. And there's some other aspects there too, such as if dividends are prevented from being distributed. Just some other indicators there, the purpose and use of assets. Are assets used primarily to provide coaching, training and competition for amateur players in the community? If yes, that might indicate we have a not-for-profit entity. Alternatively, are assets used to generate a financial return for its members, which would go to supporting we have a for-profit entity. In terms of funding, it's another indicator. Does the club receive funding from membership fees, donations, sponsorship and community grants, which do not establish a financial interest in the club? Alternatively, does the club receive funding primarily from members and other resource providers who are expecting a financial return on their investment? So with that latter scenario, it will be supportive of a for-profit entity. Now, just lastly, the last example is a social enterprise. In that case, we have a company donates one lunch for a hungry school child at a low socio-economic status school for every lunch that it sells to the public. The stated objectives. So does it say, for instance, in its constitution, it's to help children at our SES schools by providing healthy lunches? So that would indicate a not-for-profit entity. Alternatively, is there something in there about maximising profits whilst also achieving a bit on the side a social objective of providing healthy lunches to children at our SES schools? And that may indicate we have a for-profit entity. In terms of the nature of the benefits, does the entity generate substantial surpluses after covering the cost of free lunches? And are those surpluses distributed to its shareholders or retained for additional business investment? So that may indicate we have a for-profit entity. Alternatively, are most surpluses used to provide free lunches to children in our SES schools? And that may indicate we have a non-for-profit entity. And in that case, the nature of the benefits would be basically community and social. there's quite a number of indicators there. Again, in interest of time, I'm not going to go through all of them. We've got their funding. Is Entity C's funding provided primarily by shareholders and other resource providers in exchange for entitlement to financial returns, such as dividends or other economic resources? If yes, that would support and may indicate we have a for-profit entity. Alternatively, does it rely primarily on donations and grants? And is there predominantly a volunteer workforce? And if there is, then that will be supportive and may indicate we have a not-for-profit entity. So that's just the illustrative examples. Just to wrap things up, I'll just hand it over to Clark to finish off for today. Thank you, Clark.
Thanks, Peter. Yes, indeed, we're keen to receive your feedback, and the specific matters for comment in the exposure draft. We would be grateful for your comments on those, but don't feel compelled to try to respond to all of them. You can certainly respond to one or several, and we have the general matters for comment as well. A couple of questions we have received. What is the difference between community benefit and social benefit? Well, I'm not sure that we've actually defined any specific difference between those. I think it's intended to be quite broad. The follow-up question there was, well, does community benefit or social benefit cover an entity that provides services in respect of animals? So you might think of perhaps an entity that provides wildlife sanctuaries or something like that. There's no intention that the reference to community benefit and social benefit should be limited to activities related to people. So it would clearly encompass activities related to animals or heritage or whatever it might be. So I think it's intended to be very broad, and the New Zealand guidance also does not provide any specific definition. A further question was whether it's possible for a not-for-profit entity to be required to pay tax to the Australian Taxation Office. Well, it's a very good question for the Tax Office. I'm sure they will apply their tax legislation appropriately, but the principle of mutuality, for instance, does mean that you can certainly have mutual entities, which in many cases may be not-for-profit entities, depending on their objectives, paying tax on income which is derived outside their set of members, for instance. So yes, it's certainly possible for not-for-profit entities to pay tax, and so the mere requirement to pay tax of itself does not determine whether an entity is a for-profit or a not-for-profit. Your feedback most welcome. The slide shows there are a number of ways you may wish to provide that feedback via the website, LinkedIn, email. We will send a feedback form to all the registrants for this session later, so we'd appreciate your comments as well. And here we are. You will be able to contact us should you wish to. So that's me, Clark, and my colleague Peter. And finally, just to say there are a number of ways that you can stay in touch with the AASB. The slides and the audio of this presentation will be published on the AASB website, so you will be able to come back to that. We do certainly appreciate your attention and participation today, and we hope that our presentation has enabled you to understand what the exposure draft is proposing, and will therefore enable you to provide some very helpful comments to the AASB. Thank you very much, and good afternoon.
Thank you.